Hello there. Today I am recording this because today I'm going to start a journey. And by journey, what I mean is I'm starting an investment journey. I constantly see online, and I mean constantly, I see online all these things about triple leveraged investments being poor investments. And I constantly hear about volatility decay. And just to give you an example of volatility decay, let's say you invested $100 in SPY, all right? You put $100 in SPY, it goes down 20%. These are theoretical numbers. Obviously, it's never going to go down 20% in one day. I mean, it could, anything's possible, but let's say it went down 20% in one day. It would take 25% to rise up to the same dollar amount. So it takes a bigger up than it does down to regain your investment. When you triple the leverage, let's say you triple that, so 20% on the underlying, you triple that, it would go down 60%. That'd be $40 left on a $100 investment. It would take you a 150% increase to reach the same level. So this is the argument I always see online about how volatility decay, plus the high fees, by the way, there's pretty high fees in these triple leverage ETFs. Um, that's the argument I always hear about why triple leverage investing doesn't work. But I'm gonna disagree because I'm just gonna pull up Robinhood. I'm gonna pull up my Robinhood account. I'm gonna be honest, this is what I've got right now. Kind of a mess, and we'll get into that. My investments are kind of a mess right now. This is my individual. I have a retirement account. This is my retirement account, way safer, way more normal, but it is all equities, but way more normal. But I'm so we'll get into the reason I'm bringing this up is because you look at this one's gonna be a mess, and like I said, we'll get all into it. You see this talks about how triple leverage ETFs are a loser long term, but here is the long term performance of UPRO. Now this started in 2009. UPRO is a triple leveraged S&P ETF, and you see almost a 10,000% return. And then I look at SPY, or whatever. We can go VU, whatever. This one's the longest though. SPY's been around for a while. Um, SPY has been around longer, another 9 years, at least on Robinhood. It might be older than that. I think Robinhood just only goes back to 2000. But you look at SPY, and it's only go 400% compared to a 9,900% return. I mean, at this point, 2009 is a 15-year return, right? 17-year return. Or wait, 18-year return? Whatever it is. 17 years. 17 years since that started. This is a 26-year return. So I start to doubt. I'm like a little doubtful. I'm like, I don't know if they're right about this 3x ETF. Now bear in mind, this only goes back so far. That's what test folio is for. A test folio lets you see S&P up to 100 to like a really far back time. And we can backdate. This is 30 years back, starting at $500 and introducing $500 a month. And what do we get? You put in $180,000 and you get back a million. Incredible. Incredible. You 10x your money almost. Well, I'm sorry, more like a 8x or 6x or so. I'm sorry, not 9x. So this is a cumulative term of 1,720% return. Okay, we'll just have this is 30 years. We can even go back a lot of years. We can go back 40 years. I believe this goes back like 100 years, but I mean no one's living 100 years, so I'm just going to show you a couple of different ones. 40 years, 7,000% return, incredible. You go back 50 years, you get an even better one. You get a 26,000% return on a $300,000 investment over time. You get $14 million. Okay, great. Now, what if we do triple leveraged? What if we add triple leverage into this? I'm sorry, I just got to turn this off. So this allows you to do triple leveraged, and all you do is L equals 3. Question mark, oops, question mark, L equals 3. This just means, am I stupid? There we go. This just means that the daily leverage is reset every day. And what do we get 30 years back? 30 years back, you notice that SPY leverage outperforms at 3x over 30 years. And there's barely any times, now the beginning period you'll notice is lower, kind of, basically the same, up until a huge crash in 2009. Obviously 2000 had a big decrease, but it actually kind of picked back up. So 2000, 2009 was the bad times, right? But since you're dollar cost averaging in, it's not that bad, and you actually regain up around right before it crashes, you kind of equal out. Then you crash hard. 2009, you crash hard. You don't regain till 2015. And then 2015 onwards, holy cow, look at these returns. Even after 2020, it's so much return that even after 2020 and a big drop in 2018, 2019, you're still demolishing. Even look at this. This is the 2022 drop. Oh, wait, no, I'm sorry. This is Liberation Day. Even with a massive Liberation Day drop, you're hitting all-time highs consistently. Now, the problem is, look at these. Max drawdown, 98%. There's a point in here, it's probably in like 2001 area, that you've lost 98% from all-time highs versus 55, which is a lot as well, 55% from all-time highs. But you lose serious amount of money. And but the thing is, you look at any period of time, okay, 40 years. Okay, oh, 30 years, I'm cherry picking with the bull run. Okay, but 40 years kind of does the same thing. You lose it in the same area, right? You lose it. In fact, 2001 isn't even that bad if you go back further, if you've been investing for longer. It hurts, but you still almost have enough money. And then, yeah, obviously the 2008, the financial crisis is kind of what takes you out. But then once again, this bull run takes you out. You go to, and even 2020, it hurts, look at that. But you're still up double on triple leverage. I go back 50 years and look at this. Once again, doubling the performance, and it's years and years of building a portfolio. And this even makes 2000 drop not that bad. It's the 2008. It's the two drops in a row really hurts you. But even the 2000 drop isn't that bad in comparison. I mean, you're at like 25% portfolio value, 30%, or sorry, 75% portfolio value. You're not the same level, but look at this. There's some stressful times after these big crashes. But overall, over long periods of time, you can see, let's go back 60 years just for fun. No one's going to invest for 60 years, but just for fun, you kind of end up with the same result, you know? Not as much, because now we're 60 years in, and you really lose a lot of value after these periods of time. The flash crash over here, 2000, 2008. You lose a lot of value, but you still end up on top over long periods of time. You always end up on top. At least in the last 60 years, you end up on top having triple leverage. You consider yourself a winner. Now, yes, you eat a lot of volatility, and hey, during during an what's called Liberation Day, you're fucking pissed, but you're still up. So you see that the growth of the triple leverage always wins. Now, some periods are less than other, but it always wins. So now you have to ask yourself, this is rough. These periods are rough, right? We see these points like the flash crash, all right? We see these points, flash crash. We see these points, bad stock market returns over here. We see um, the dot-com bubble bursting here. We see the great financial crisis. We see 2022 hurts. We see Liberation Day hurts. We see these points where the stock drops like crazy, and you get these periods where you're losing fucking 90% of your wealth. So then I ask myself, okay, I get it that these periods of time are very volatile. They're scary. They're awful. And if, God forbid, I wanted to retire in 2011, I'm down $3 million, right? If I invest for 60 years, it's a bit, what's the word, overfitting if I say, oh, it's to today it looks good, but maybe I want to retire here. But here's how where you fix it, and here's where I want to fix it. The trick, in my opinion, is rebalancing. Okay? Now, instead of investing in straight S&P and straight leverage S&P, what if we go S&P, but we add extra steps? And what I mean by steps is we add some diversifiers. Now I'm going to put gold and bonds just as an example. There's other diversifiers you could use. This one, BND, only goes back a certain length. I may instead use 0Z. Oops, click the wrong button. What did I just do? Oh, good lord. I don't know what I just did there. My bad. Well, whatever. We'll go back to 30 years. And so this is what I'll do. Well, let me do two more. Sorry, just fixing that real quick. Now this is so just to show you. So this allows you to rebalance. And I like quarterly, at least from my back testing. Quarterly seems really good. Yearly actually performed better, but it seemed more situational. Like it seemed like it kind of luckily worked out better. Um, Spy Lev and Spy Lev Rebal. Okay. So if we do 100% Spy, 100% Spy leveraged, and 60% Spy, 20% gold, 20% bonds, and back test it. And you're going to see some magic here. You're going to see some real magic. So first of all, you'll see this one. Oh, hold on. I got to change the $500 a month, starting at $500. Okay, back test it. And you're going to see here, okay, SPY rebalancing does not perform as well. It does not perform as well. But what you'll notice about this is that the bad times are so much less bad because you're holding bonds during this time. Look at this. So here, SPY is at, this is the perfect example. SPY is at 60,000. SPY leverage is at 8,000. It's more than 6 times, sorry, it's more than 7 times the value. Regular SPY is worth 7 times what leverage SPY is in 2009. SPY rebal's only half the value, right? It feels a little better than going through these awful times. Hey, God forbid I had to retire at this point. At least I really haven't lost money. I've basically kept my money. Now I lost it to inflation, but at least I kept my money, right? In these rebalancing times. And you'll see that in the bad times, here we are, 2020 COVID here. There's a crossroads, and SPY Rebal actually wins. It actually beats it, even though you have to rebalance at the worst possible time. It beats it. You see 2000, you see the 2000 dot-com bubble, and look at that. It's almost holding its own carrying bonds. Now it drops off. Oh, sorry. That's this area. Yeah, it drops off, but it holds its own a bit. And it you don't sacrifice that much performance for these great returns. You really don't. And it starts to look better over even longer periods of time. If I go to 40 years, look at this. SPY rebalance actually beats the other ones. And that's because it actually does so well during these hyper moments where you're not overdoing your money into these triple leverage things. Look at this. You actually don't drop below SPY here. Once you have a long period of time. Now you go drop down here. Once again, the financial crisis 2008 is what it is, but once again, look at that. That's really not that impalatable. And then you get back by around 2011, 2012. I mean, you're tanking in 2009 like everyone else is, but you kind of come back very quickly once you rebalance quarterly. And I'm just making sure that's rebalancing quarterly. Yes, okay, good. I can turn these off. But and then once again, similar situation where you're these points where you drop off. Look at that. You outperform by $800,000. Here where SPY leverage, and then after that, there's not a point where triple SPY beats you because now you're a little bit diversified. Now this one only goes back 40 years because of BND, so I'm actually going to do it with ZROZ. I'm going to do it with ZROZ, which is a 25-year plus bond. Now I prefer BND because it's now if you do ZROZ, you actually always outcompete, but I think that's a little lucky. Did the numbers change there? Hold on. Why did that change? That's weird. I don't know why that changed. Anyway, you go back 50 years. You, like I said, I don't like this one as much. This is 25-year plus bonds. And it actually always wins, except for in 2000. It literally always wins, which is crazy. But I mean, you could do that. It's not the kind of bond I want because especially where we're at with interest rates, and in also in 2022, it had a crazy crash, the zeros, and I could probably pull that up. This is 25 plus year U.S. Treasury bonds. And maybe in other videos I'll get into why I don't like that. But yeah, 22, look at this crash since 2022. It's been straight down. Now, to be fair, BND has been somewhat similar in its trajectory, but it's been a lot less. Okay. And the dividends have been a little, or distributions have been a little less bad. But this is my beginning thesis, okay? And I'm starting this very soon. I'm going to invest in exactly what you're seeing. I'm going to do BND, the Vanguard Bond Fund. I'm going to do gold. I'm going to do UPRO. And I'm drunk while recording this, but the reason I think it's a great idea is because it gives you long-term growth with some stability. I think gold is definitely going to be on the up. I'm not as sure about bonds, but that's the reason I want to do bonds total, because BND is the total bond fund. There's a lot of US only bond funds, but I really want to do BND because it's every bond, and I'm not 100% secure in American, because I'm already going with SPY, right? SPY is US companies only. If they had a triple leverage VT, I'd do it, but they don't. So I'm going SPY. I don't want to go too heavy America. So gold, I feel like with inflation rising, this is good, and it's uncorrelated to stocks. Same thing with bonds. I want it uncorrelated. I want the returns now. There's an argument as well to be made with managed futures as well. I'd probably, if I was going to do that, I'd probably do it instead of gold because managed futures is commodity exposure anyway. But I'm going with gold. I want to show you the journey, and we'll see where it goes. Thank you for watching.